I'm Will Close-Brooks, Director of Business Development, helping lead Respira's expansion and helping us to keep abreast of everything that's going on in the market. I'm going to be talking briefly about supply and demand balance in the voluntary carbon market, the implications that has for pricing, and also about some of the infrastructure developments we've seen in the market over the past 12 to 18 months. Starting with demand, we've seen significant growth year on year in the voluntary carbon market, amounting to about 100% growth in dollar terms between 2020 and 2021. And most leading analysts, such as Trove, forecast continued growth at a multiple of 10 times out to 2030 and times 20 by 2040. Where is that growth coming from? It's coming from corporates setting climate targets and nature targets. Many of those are being driven by mandatory disclosure and reporting initiatives, such as the TCFD, the Task Force on Climate-Related Financial Disclosure. Others remain more voluntary, appealing by demonstrating climate credentials to their end consumers or users in the case of more retail-faced businesses. And now we see over 3,000 corporates that have set net zero targets. These span multiple sectors, ranging from high-emitting, hard-to-abate industries such as international transportation or oil and gas, but also more retail-facing sectors such as food or fashion, where they're all looking to utilize high-integrity carbon credits as a way to compensate for their continued emissions on that decarbonisation trajectory, but also to balance out their residual or unavoidable emissions at the point of being net zero. And we therefore see a critical role for high-integrity carbon credits out for the near to medium term. With this increase in demand, we also expect to see rising prices. This is fundamentally because supply is inelastic. It takes 2 to 3 years for projects to come online, and those that actually sequester or remove carbon from the atmosphere, such as reforestation projects, materially longer than that to issue their first credits. In line with most market analysts, we expect to see a rising forward price curve over the coming decade. And from a wider perspective, many of these nature-based projects are undervalued in terms of the ecosystem services they provide. They're currently transacting at around $10 a tonne. This compares with compliance markets, which involves allowances or effectively permits to pollute, where prices are far higher. In fact, we saw in 2021 prices within the EU emissions trading scheme, allowances topped $100 a tonne. Article 6, which was agreed at COP26 in Glasgow last year, has provided some form of foundation for prices between the two markets, the voluntary market and the compliance market, to potentially converge over time. We're starting to see some of the critical infrastructure that we see in other commodity markets being built out, driven by a push for further transparency and integrity. On the demand side, we're expecting to see the release of the core carbon principles later this year. These will set minimum qualitative criteria for projects, and we expect these to be embedded into market contracts. Contracts have already been developed by some of the leading exchanges, such as the CME Group and ICE. Furthermore, standardized contracts are being developed by ISDA, the International Swaps and Derivative Association. On the supply side, there is a parallel initiative called the VCMI, or Voluntary Carbon Market Integrity Initiative. And this is more focused on the claims that corporates using carbon credits can make, principally to address allegations of greenwashing and to ensure that any claims are credible and science-based. In addition, we've started to see the emergence of carbon market ratings agencies that look and feel very much like traditional credit rating agencies. These groups are using new technologies and harnessing geospatial data to provide more accurate and efficient readings of carbon sequestration. So we've talked about both demand and supply initiatives that are ongoing in the market and some of these ratings agencies. I think if we take all of those together, we see an increasingly robust foundation for the market to grow in a way with integrity over the coming years.